Welcome, students. So, next thing we will talk in this process of learning about the project management as a whole is the project risk analysis. That's going to be the next part of discussion for us. And this is very important and integral part of overall project management or overall project finance. And risk analysis is going to help us to understand that to what extent our proposal or maybe the new investment option is going to be a safer investment, and if any kind of the risk is involved, we are going to understand it in advance. And if it is possible that we can do away with that risk, then we are going to do it. But if it is not possible, then certainly we have to think it seriously, that if it is the riskier proposition, we'll have to drop it, or we have to look for the alternative ways of making investment, or maybe making investment into this venture after making certain improvements or taking some safeguards. So when you talk about the risk analysis, it's a very integral part, as I just told you. And if you remain optimistic all the times and feel that everything is going to be positive and as per our expectations or as per our maybe likings, then it's not going to happen, because you are going to deal with something which is not presently in shape, is going to take shape in future, and is going to be something of an entity of future, or that business is going to come up in the time to come. So at the moment we are only going to make estimates, and practically how the things will come out, that will be the thing to be seen in future. So anything which is not in shape today, and we are going to, or we are anticipating that this is going to happen like this, so it may be possible that it happens as 100% what we have thought about, but it may not, and it may maybe deviate from the expected results. So what is the extent of deviation? If the extent of deviation is higher, then we will have to maybe find out the corrective actions. We have to take the corrective actions, and if it is not possible to take the corrective actions, we'll have to sometimes abandon the investment proposal, and we have to look for the alternatives. So when you talk about the risk analysis, we have to look for the techniques of the risk analysis of the projects or the new investment options. Maybe it's a firm, means a project by the existing firm, or by a, say, you can call it as a group of the promoters as a startup, or maybe any other form of the venture. If it is going to be a standalone, in that case also it's going to be, maybe it can be a riskier proposal. And if it is going to be the part of an existing firm, still it can bring some amount of the risk, and even it can affect the existing financial health of the firm. So in both cases, this miss even in case of a standalone as well, or maybe in case of being a part of the existing firm, we have to scan it carefully, completely, from the perspective of the risk, and we have to find out that whatever is going to happen, or whatever the estimates we have made at the moment, they all are going to come true, and largely going to come true, and we are going to achieve the results, or maybe the objectives for which this venture is going to be set up. So when you talk about the techniques of risk analysis, or ways of risk analysis, so we are going to learn about the different techniques or different ways of managing the risk or taking care of the risk in the investment projects. And in this case, we are dividing it into two parts. First part is the risk analysis of the standalone projects, and it is the risk analysis of the existing firms, the projects by the existing firms. In the contextual risk analysis, we call it as the contextual risk analysis, especially for those firms who are already existing, and they are coming out with the new options as expansion, diversification, or the growth projects. So they also need to be properly taken care of, because new ventures can cause a threat to their financial or operating structures also. So from any perspective you look at, the new proposal, the new venture should be safe, and if there is any kind of the say unexpected thing going to happen or expected to happen, that should be taken into account, and we should try to minimize the risk associated with that investment option. So when you talk about the standalone projects, or maybe the projects coming for the first time, nothing is in existence, so it may be a startup, it may be by some experienced entrepreneurs, they are going to set up a new venture and for the first time. So that is called as a standalone venture or the standalone project. So analyzing the risk of the standalone projects, we have the different techniques, and analyzing the risk associated to the existing firms, we have the different techniques. For analyzing the risk associated to the standalone projects, we have the six very good and interesting methods of taking care of the risk. They are most effective, most, you call it as the valuable methods, and we should be clearly understanding them, that being a promoter or an entrepreneur, we should be clear about that if we are going to make any investment of any kind, there should not be any kind of uncertainty, any kind of deviation from the expected results involved. And if that is expected, we should visualize that in advance and take the corrective action, so that whenever we make the investment and try to give shape to this venture, we are largely on the safer side, and finally we are maybe on the track of a very safe investment, and whatever we are expecting to happen in the positive manner, that's going to happen. And we have already visualized that if anything untoward going to happen, we have already taken care of that. For example, when we talk about that Anchor Fruit Beer project, so miss, you see that they had not analyzed the risk in advance, that they, when they thought of manufacturing the fruit beer and introducing the Indian market, so huge risk was associated to that, because Indians being the market being highly price sensitive, we had the limited income, and that too maybe you call it as close to maybe more than 25 years back. The situation was totally different. Today, though GDP is growing, India is growing, we have become the fourth largest economy in the world, and income level of the people is growing. But at that time, the market was totally different, and introducing a product like fruit beer at that time was certainly full of you call it as the flaws and bottlenecks. So the company didn't realize that why should people opt for the fruit beer, which is comparable in price to the alcoholic beer, and what are the different alternatives available to the fruit beer in the Indian market. And people, if have to pay such a high price for the fruit beer, will they pay for it? Do they have that much amount of the income in their pocket or in their hands? So all these things they should have properly analyzed, they should have taken care of, and after that they should have made the investment, so that it is not going down in the drain. But they fail to say look forward into the future, or understand the sentiments of the market or the customers in this market. And finally, when they made the investment, the product which came out of the investment was rejected by the market, by the people, and finally they have to lose that huge investment. So always play safe, always maybe make investment maybe at the smaller level or the smaller scale, and if it becomes a successful, then grow with it, and then you can increase the level of investment, you can bring the funds in the large amount from the multiple sources, and then you can expand, or you can grow, or you can do whatever you want to do. But initially, if you are not visualizing what is going to happen with the venture, and if you are starting at a large scale or a bigger scale comparatively, and you are not knowing in advance that how the market is going to respond about your product or the service, then certainly you are going to fall flat, and huge risk may be involved into any kind of the business proposals. So we have to be very careful about that. That's why a company, a group like Reliance, when they came out in the market with when they entered into the mobile telephony market through Jio, so they were very careful. They knew it, that market is highly competitive, and very good four players are already there in the market. We are going to be the fifth player in the market. Four players were the bigger companies, but other than four players, there were smaller companies also in the market. It was highly competitive market, and they had to enter as a maybe the fifth larger player in the market. So they analyzed it very carefully, and they thought to understand the say temperature of the water, and to understand the market in that way. They gave the services free of cost also. They gave the reason to the customers to enjoy their service, see its efficacy and efficiency which is involved into that service. And finally, they gave some time the people to decide to become their customers, and finally it became a good success or a good player in the market. So any product you talk about, if you are moving into the venture, you have to be very careful that maybe we can think a product is going to be huge success, a service is going to be huge success, but it may not be. And many startups, though we have today 160,000 registered and recognized startups in India, but all of them are not becoming unicorns. All of them are not growing. All of them are not sustaining. And many startups fail after certain amount of time, because they make investment at a unexpected scale. For example, you take the example of Byju's. Byju's was doing good. It was a good startup, or it was doing good. It was growing also. But they committed some blunders and they borrowed huge money from the market to acquire some existing companies who were not very good options. And as a result of that, the whole startup that moved into a very riskier situation. And finally, a situation came that it has to be declared as bankrupt because they were not able to pay that huge debt they borrowed from the market. And finally, Byju's became a sick startup, a sick company, and now slowly it's dying. It's not able to cover up, it's not able to sustain. So it happens many a times that many startups fail, many even existing businesses fail. And that happens when we are not able to visualize the risk element involved in those investment proposals carefully and correctly, then it all will happen. So you have to be very careful that whenever you are going to make any investment into any venture, means you understand what is the source of the risk and what is the cause of the risk, because you had some amount in your hands and different investment avenues were there. Safest investment avenue would have been that you give your money to the bank and you don't take any risk and you get whatever the return the banks give it to you. You're not satisfied with that, so you had the second option: go to the bond market, earn little more than bank rate, and you still are not going to take huge amount of risk. Still you are not satisfied, you go to the equity market, make investment, get some better returns, but take the risk accordingly. And if you are still not satisfied, you can go to the real estate market and you make investments and get the returns. But because you are not satisfied with either of these four options, bank rate, bond option, stock option, or the real estate option, that's why you opted for the business, that you want to make investments into the business and you want to become entrepreneur. So when you are going to take the, you are expecting the higher amount of the, or highest amount of the return, right? The return which was not available from the bank, from the bond market, from the stock market, or from the real estate market. You expected that this return can be from your business. So when you are expecting the highest amount of the return, you have to expect the highest amount of the risk also. And you have to visualize that riskiness of the project, that venture in advance, and only then you have to proceed further. So for the standalone projects, we have the 6 techniques. All these techniques are not usable or are not very effective or maybe usable at the same time. Any one or two techniques we can use for our analysis or for visualizing the risk associated to the projects. So first one is the sensitivity analysis, second one is the scenario analysis, then we have the break-even analysis, we have the Hiller's model, we have the simulation analysis, and we have the decision tree analysis, right? So 6 techniques are there which are maybe very good effective techniques to go for the risk analysis for the standalone projects. And for the contextual risk analysis, maybe for the projects which are being launched by the existing firms, so the risk analysis can be in the form of the corporate risk analysis or the market risk analysis, right? So these two aspects are also there for the existing firms in the projects to be launched by the existing firms. And for the standalone projects, we have the 6 techniques available, but the most popular techniques are first 3. People use sensitivity analysis, people use scenario analysis, and people use break-even analysis, right? But hardly there are the misconcerns who use the Hiller's model. Sometimes we use the simulation analysis and decision tree analysis, but the first 3 tools, 3 techniques are going to give us the desirable results, that you can check the sensitivity of your project to some variables, and you can build different scenarios, or you can try to find out that when you are going to achieve the accounting break-even point or you are going to achieve the financial break-even point. So that way you can do the risk analysis. So we will learn and discuss all these techniques one by one, and we will emphasize more upon the first 3: sensitivity, scenario, and the break-even analysis. Other 3 will also discuss in the context, but not in detail because of the time shortage. So, but you should be very clear about the sensitivity analysis, scenario analysis, and the break-even analysis. As far as the break-even analysis is concerned, we will calculate both the break-evens, one that's accounting break-even also, and then the financial break-even also. So financial break-even is something new which you must not have commonly heard about. So we will learn about what is the financial break-even and how it is different from the accounting break-even point. So now we will go ahead with this, that sources and perspectives of the risk. So what are the sources and what are the perspectives of the risk? So perspective of the risk and sources, when we are talking about where the risk comes from, sources of the risk means where the risk comes from, you should be very clear and you should be looking at these important aspects or these sources. Project specific risk can be 1, competitive risk can be 2, industry specific risk can be 3, market risk can be 4, and international risk can be 5. Project specific risk, which is associated to the product or the service which you are going to manufacture or generate out of that investment, that's a very, very important component, and you have to look at it. What kind of the product you want to manufacture, what kind of the service you want to generate. That's the reason that most of the startups, we say that we have the 160,000 recognized startups, recognized by the government, DPIIT. So, these recognized startups are there. But out of these 160,000 startups, recognized startups, or maybe 100 plus unicorns, how many are there in the manufacturing sector? I think very few, or maybe can be counted on the fingers, who are into the manufacturing sector. Most of them are into services sector or into the e-commerce activities, right? They have built up their own apps or platforms, and they are only distributing the goods and services. They are not manufacturing anything because they want to avoid the project specific risk. Because if you manufacture any product and if it is not saleable in the market, if it is not liked by the people, so it will create a huge problem. And when you go for a manufacturing, creating a manufacturing facility, you need to have the fixed assets also. And when you create or make investment into the fixed assets, land, plant, building, machinery, so the cost of the product per unit increases because of the high amount of the element of depreciation. Though on the land we don't charge any depreciation, but on the plant, machinery and other fixed assets you have to charge a depreciation. So that part of the fixed cost, when added into the total cost of the product, right, of the total production as well as the per unit, so per unit cost goes sometime more than the expected cost or being a competitive cost. So people avoid manufacturing and setting up the manufacturing facility because the cost may increase. That's why when I give you the example of that Akai TV by Kabir Mulchandani, he didn't set up any manufacturing facility for manufacturing of CTVs. Rather, he assembled the product and he got the ready-made parts from the, say, Taiwan or maybe the other world markets, Korea, Taiwan. He simply got those parts in millions of units, he assembled them, and finally he converted that into a CTV. So he could save a significant part of the total cost of a CTV by way of avoiding the depreciation, because no plant was set up, only it was a assembling unit. So project specific risk. Similarly, when you talk about that fruit beer project, naturally the product was not saleable in the Indian market because of the some inbuilt traits of the Indian market. So why should you venture into something which is not saleable in the market? That's why to avoid this risk, project specific risk, you have to do a very critical market and demand analysis, so that you are finally, whatever the estimates you are going to have, you are going to conclude that this much of the sales we are going to have at any cost, we are going to be successful venture, because if this much amount, maybe even 0.05% of the sales you are going to have, less than 1% of the sales you are going to have in the market, that's also going to give the sustenance. Maybe initial years we are incurring losses, but we are going to grow at a faster pace, and we are going to increase the sales from the 0.05% to the 0.5% and then to the 5%. So that is going to be the say growth prospects of the venture. So if you are going to see in advance, fine. But if you are not going to see and you are going to launch a product which is not saleable in the market, you are going to fail. Similarly, if you are going to launch a service which is not accepted by the people, you are going to fail. That's why Jio, when they launched this mobile service, or that they moved into the mobile telephony, they kept the service specific risk also into their mind, and the second risk, that is a competitive risk, into their mind. Because the mobile telephony market was a competitive market in 2016 as well. Big four players were there in the market. Small players were also there in the market. So entering into the market as a fifth player, they had to give the services free of cost in the beginning. So they that way gave an edge to the competitors in the market. They placed their service in such a way that people were bound to use it, taste it, And finally, when they found it efficient, so they accepted, they started paying for it, and finally Jio became the second largest service provider in the country. Then we have the service industry specific risk. Some industries are there which are affected by government policies or the tax rates, or maybe because of the changing market dynamics. So industry specific requirements and the risk also brings some kind of the risk. For example, there is a input requirement, specific input requirement. So in the industry specific risk, when the industry which is manufacturing certain products, and where the input requirement is very special or critical, so you will be not successful in that kind of the industry, or because of the industry factors, because raw material is not easily available, or maybe the sufficient facilities, maybe the utilities, electricity, water, these are also not available, and that investment we are not able to make it, that's not suitable, we cannot make it. And similarly, the market risk is with regard to the financial markets, or the, you call it as the capital markets. If you're going to raise the funds from the financial markets, and if the funds are not easily available, or maybe sometime you are going to raise the funds from the sources to avoid the risk, so your cost of the funds will increase. But if you want to minimize the cost of the funds and you raise the funds through debt, so other way around, the risk is going to be there in the business, and your investment is going to be a riskier option, because you are going to raise a fixed liability on your head. Then we have the international risk, that maybe because of some international changes. Now, these days, for example, you are seeing that Ukraine Russia war is going on, or war is erupting up in the different parts of the world. So, if some industry is based upon the oil inputs, or maybe the oil as an input, so it's going to create a problem. Or maybe some heavy transportation process is involved with regard to transporting the products from the one place to the other place, and if the oil prices go up, naturally your transportation cost will increase, and that transportation cost will translate into the increased product cost, and your product may become less competitive. So anytime the international factors are going to play the role, it can be import based also, it can be export based also. For example, who visualized that Trump, after coming into power in US, he will create this duty war, or duty related problems he will create. So maybe in India as well, exporters are maybe looking towards him, that what level of the duties he raises or he announces, and what say additional pressures because of the change in the duties or the levies, means duties being levied by the US, is going to change the overall export scenario for them, import scenario for them. So any industries in India who are dependent upon the imports of certain inputs from US, or who are sustaining on the exports to the US, they are going to be negatively hit because of the international risk. So anytime this kind of the risk can come to us, so we have to be very careful that if there is a project specific risk, always try to manage it. Competitive risk, always visualize it, and remain conservative. Industry specific risks should be identified. Market financial risk should be identified. And always, though international risks are not in our hands, but to some extent we can visualize that if there is any kind of the international changes going to take place, any risk going to happen, what we will do. Then perspectives on the risk: standalone risk, firm risk, and the market risk. Standalone, as I told you, to a new venture. If it is only one project by the group of entrepreneurs, maybe a startup, or maybe by experienced entrepreneurs, this new venture is going to be. If it is a standalone project, so what kind of the risks are going to be there, and how to deal with those risks. If it is a project by the existing firm, then it may affect the health of the existing firm as well. It may affect the operating or financial structure of the existing firm as well. And it may be the market risk with regard to the financial markets. So it can increase the financial cost of the firm. It can increase the financial uncertainty with regard to different sources of the firms. And if you raise more funds by way of the debt from the debt market, then certainly it would make the firm distressful. It can increase the distress level in the firm. So that would be another risk may be associated to the projects. So we have to look at the sources of the risk and manage that risk. We have to look at the perspectives of the risk, and we have to manage that risk. And finally, the objective is that you have to minimize the overall risk associated with any investment option or any investment proposal. Now, measures of the risk. When you talk about that, how we can quantify the risk or measure the risk, these are the four different measures. Or finally, we can use the most common method here. It is that is the standard deviation or the variance. Range can be one thing that you expected that my NPV would be 500 million in the initial years, or maybe initially you call it as that NPV would be zero in the initial years, but it will increase from 0 to 100 and then to 150 and 200. So you can decide a range that my NPV would be ranging in the next 5 years or next 10 years. My NPV would be ranging from the 100 million or maybe from 0 to 500 million over the period of 10 years. So even at 0, the project is acceptable, and then when it goes up to 500 million. So that range is very, very broad. So you can narrow the range so that you can understand that within that range, is it possible for us to manage the venture or not possible. But largely we use the standard deviation or the variance as the risk measure. It can be standard deviation of the cash flows, right? Or maybe in terms of the largely because cash outflow is at one point of time, cash inflows are at the multiple point of time, and largely they are the annual cash flows. So what is the standard deviation or the variance expected in the cash flows? If the more variance in the cash flows is expected, it means the project entails a high amount of the risk. You are not able to find out. In the first year, your cash flow is 100 million, in second year, your cash flow is 500 million, and third year, your cash flow is again down 200 million. So look at the variance in this 100 million, 500 million, 200 million. So how it is going? Going up and going down, severely going down. So high amount of the standard deviation is there. So normally the best measure of risk is the standard deviation in the returns or the cash flows. And we have to find out that the projects where the cash flows are largely stable or sustainably going up, so they are more better option, you can call it as. But where the cash flows are presenting a zigzag kind of the picture, is a picture something like that, this kind of the picture, so it means they are highly riskier. Look at the standard deviation involved here. You have a cash flow here, it reaches here, it comes down to this part, this part, this part, and this part. It means we are not able to find out that how much risk is associated because of the cash flows. And if your cash flows, especially the cash inflows, are not stable, then how can you calculate the NPV? You can calculate the IRR. And how would you say that the expected cash flow would certainly be available in the project? So the best measure can be standard deviation or variance of the cash flows. You can calculate the coefficient of variation also, or the semi-variation variance, but no need to go so much in detail. Only look at that one measure is in the form of the standard deviation or the variance. In the finance also, when we go for the risk analysis, we use the mean variance theory as far as the market risk is involved or the stock market risk is involved. In the portfolio theory, when we discuss, we learn about that mean variance theory is the most popular theory. And there also we talk about the average return from an investment, or the variance from or is associated to that inflows or the investments or the returns from the investment. So all those standard deviation or variance and the mean average return as well as the standard deviation associated to that return is the commonly used measure for measuring the risk. So there can be 4 or 5 way of looking at the risk, but the most appropriate is the standard deviation or the variance, and you can use the variance as the most appropriate measure of risk, variance in the cash flows or the returns associated to the project. So now we will talk about the different techniques, how we can handle the risk associated to the projects. And as I told you, there are 6 techniques for handling the project risk associated to the project. So first one, as I told you, was the sensitivity analysis, scenario analysis, break-even analysis, Hiller's model, then simulation analysis, and the decision tree. So now first is the sensitivity analysis. And when we talk about the sensitivity analysis, it's going to be a very useful and interesting tool, and is most widely used in the industry for judging the riskiness of the projects or risk associated to the projects. So some firms use the sensitivity analysis, some firms use scenario analysis, and some firms use both along with the break-even analysis. So these 3 tools are the most effective and most you can call it as the useful tools for say visualizing the risk associated to the projects or any investment options. So what these 6 techniques are, we will discuss the first 3 techniques in detail, remaining 3 techniques not in detail. So we're talking about the sensitivity analysis, and trying to know about that how the sensitivity analysis is going to help us about the overall risk analysis of the project, and similarly the other techniques. So one by one we will know about all these techniques, learn about all these techniques, and we will like to know that how much risk is associated with any investment option and how to read that in advance. So sensitivity analysis as well as the other techniques of the risk analysis for the standalone projects we will discuss in the next class. Till then, thank you very much. I will stop here for the moment. Thank you very much, and we will meet in the next class with the discussion on the different techniques of the risk analysis associated with the new projects or the new investment options. Thank you very much.